Your latest thoughts then ahead of Jackson Hole, Mark. Earlier this week, you were very preoccupied by the political pressure being applied to the Fed and what that will, either in the short term or longer term, do to the long end of the curve.
Absolutely. I think the really important thing to remember that going into Jackson Hole this weekend, it's clearly going to be market moving today. There seems to be a complete divide in the market, whether it'll be hawkish or dovish. For what it's worth, and not very much, I think he's going to be hawkish relative to expectations because, of course, there is no economic justification for a rate cut just yet. And he's probably going to have to point that out, particularly the topic on the labour markets. But that's not worth very much. The much bigger point is that Jackson Hole, Powell's speech is going to really matter in the short term. Today, probably into next week. It's not going to change where we're going to be in a few months' time, and that is US assets are going to continue to suffer. Monetary policy in the US has been completely undermined. Doesn't matter what happens this weekend, it's been undermined. We know the fiscal situation is problematic and got worse. We know institutional credibility has been undermined. We know that the cost of doing business with the US is both more expensive and more uncertain and more problematic. It is going to continue to be a world of US underperformance. We've seen US stocks lose a decrease in their share of global market cap this year. That will be an ongoing theme. It'll likely accelerate into the end of the year. It's been accelerated a little bit in August, only slightly, but it's likely to continue. And linked to that, we're likely to see the dollar to continue to decline. So it's just a matter of when do you play the next big dollar down leg, not if.
Mark, US assets have outperformed over the last 3 months while all of this has been going on. Why?
Sorry, US assets have not outperformed over the last 2 months.
They've outperformed European equities. Okay, I'm being simplistic about this. US equity markets have come roaring back over the last 3 months. Are you judging them both in
local currency terms?
To a certain extent,
you're forgetting about the currency, but
No, I'm not. If I put it all in euros, I've got the S&P up by 6%, and I've got the Euro Stoxx 50 up by less than 1% in euros over the last 3 months.
Okay, I tell you, you've picked two arbitrary benchmarks there, and they're important benchmarks.
Sure.
Now, a better way to look at it is the overall picture of the region versus each other. Now, I don't have the chart in front of me, but I'm pretty sure that the US share of global market cap has declined from 3 months ago. Now, specifically versus European stocks, I don't have the chart in front of me. The point is it's underperforming global stocks. It is below 48%. It was above 50% 6 months ago. 8 months ago, all those months. I'm not picking between both 6 months and 8 months ago. US share of global market stocks is declining. Now, if you want to tell me that in the last 3 months that the outperformance has been more about in Asia, absolutely. I think the much better story is in Asia. I fully believe that. I don't think it's just a choice between US and Europe. I think that Europe is the obvious liquid one for people who want to diversify from the US and don't really care about global affairs. But Asia is the much, much better story. Absolutely. The point is US shares are underperforming globally. When do you pick Europe? When do you pick Asia? For me, it's Asia.